So, some key insights on banks. The key function of banks is money creation, not intermediation. And if you tell that to a mainstream economist, that's already provocative, but it is 100% correct. Okay? What banks do, and I was a banker at Barclays Bank for 5 years, I made loans, I know exactly what the entries are that you need to create when you make a loan. You create a new loan on the asset side of the balance sheet, and when you do that, you create a new deposit of exactly the same amount that is credited to the guy who has just borrowed from you. So in terms of causation, the critical issue here is that loans come before deposits. Loans create deposits, and not vice versa. What the intermediation story misses completely is the monetary nature of financing. So the bank just provides check clearing services so that people can exchange the money that has been created among themselves for their business needs. The actual purposeful activity of the bank has been the creation of new money. And of course, it can also destroy money. This story happens every single time a bank makes a loan. And it is completely different from the loanable fund story. The implications is that new loans involve no intermediation, no funds are being withdrawn from previous users as savings. And that means, and that is absolutely critical, and for Irving Fisher it was front and center, is that banks can easily start a lending boom. Because if they can do this, they can simply grow their balance sheets by expanding the money supply, the broad money supply, that is, of course, not the narrow money supply. Okay? They do not have to attract deposits of pre-existing money.